Matthias, your portfolio is also the fixed income side defensive positioned, short duration, safe and robust. Give us some insights maybe on your portfolio, how you are positioned, and if there are any chances right now you could get on the fixed income side.
So from August in 2019, we was risk off on our fixed income side of portfolio. So we are short duration, good quality on Euro fixed income, and on US side we had long US Treasuries and US municipals, as well as investment grade corporate bonds, but only a little part. And on emerging market bond, we was short via a vehicle, via fund, and we have one contrarian strategy or unconstrained strategy for global bonds. And now we are seeing, my opinion is a little bit contrarian to Mr. Schlösser. We see default rates in high yield spread from 40 to 50% actually, and we don't think that we will see so much defaults in Europe like 40 to 50%.
Rolf, you are more on the equity side. You mentioned that you are quite skeptical regarding corporates or the credit markets. Why is that in particular? And give us some insights. Would you say, or say that it's a good chance right now for the high yield market at exposure there?
So, our equity exposure is and was always between 50 and 80%. So there's not a lot of room for fixed income. And this room was and is filled with local currency mandates and portfolios with a focus on supranational issuers. So we didn't have any investment grade and high yield bonds. And well, at the end of the day, timing is everything at the moment. So as the speaker showed, there were a few days where you could buy really cheap. So when I look at our family office, our processes are not really that quick that we can say, okay, now we buy these portfolios. And when I think about liquidity, and I would really like to talk about liquidity and listen to what the expert says, what he thinks about liquidity in these markets, because that's one of the risks I really see when you think about buying or selling at the moment.
One point to timing, that is a very important point. When we talked about to add high yield to our portfolios, we have a yield to worst from 22 to 23%. And now, 2 weeks later, there's a yield to worst from 15 to 16. So we moved up 6 or 7% in worldwide high yields, and this is it's a question of timing. It's correct. Yeah.
It's a good entry point in terms of valuations. I think the points that were raised were all correct and quite interesting actually. So maybe the first one on default rates, European default rates, that's absolutely correct, are going to be lower in Europe because also the bankruptcy code is much more protective of the employees. So it's much more difficult to file for bankruptcy in Europe than in the US. So the numbers, we would agree, single digit type of numbers for defaults in Europe. Much higher though in the US because of the size of the energy sector within the high yield sector, or within the high yield universe. So that's going to be something we are forecasting actually, double digit, maybe mid, 15, 20% in defaults potentially in 2020 just because of the energy sector. On liquidity, that was also very interesting. So maybe just telling you what we saw during March, and because I think it was a good exercise, and it was actually a pretty scary exercise, I must say. At some points, the markets appeared completely broken. It was basically, for a few days, it was impossible to trade. It was impossible to get a bid on a bond in most sectors, even IG, single A bond, single A corporate, you would not be able to sell it. Fortunately, the Fed stepped in and eased liquidity conditions really quickly. On a scale from 1 to 5, I would say that 5 being the worst, 1 being the best. We were at 1 in February, January, February. We were at 5, and for a few days, we're not back to 1. We're between 2 and 3. What has really helped on the liquidity side is that a lot of corporates, high quality corporates, came to the market in March, even the worst days of the crisis, and actually issued a lot of bonds. So that provided some information to the market, price discovery information in terms of, okay, if this bond is priced at that price, the bonds I'm holding, or the banks that are holding bonds, could price some bonds and start feeling more comfortable taking risk. But this is something that was really surprising. We knew, since the financial crisis, that banks were not holding as many assets on their balance sheet because of regulations. That we knew. We think that the fact that everybody was working from home actually created some issues in terms of risk taking, meaning a trader, by himself, not on the trade floor, but by himself in his office, was not able, willing, we don't know, to take as much risk as he would have otherwise when on the trade floor in the office. That could be one piece of explanation.
So we already talked about the US market. With the Titus, the US market, would you say it's more a no-go because of the fracking and the energy companies, or could it be even a chance because more defaults are in general priced in the US market, but you have to kind of avoid the fracking and the energy companies and pick kind of bonds or companies which could benefit from the whole situation because everything is kind of priced in that there are more defaults?
It is a tough call how the whole energy sector will play out in the next couple of weeks and months. We did have some exposure going into March, and as soon as this weekend with the Saudi Arabia or OPEC Plus meeting, we completely got rid of our energy exposure. Why? Because at this point we felt energy prices were no longer a function of demand and supply, but was some political instrument between Saudi Arabia, Russia. No idea where the US stands on that whole issue. So talking 6 to 12 months, certainly I would expect prices to rise, which would give the huge fracking industry in the US, huge by employment numbers, and talking about US high yield, I think a good quote or a good fraction of the high yield market is fracking / energy. So that should give some relief, but Tim, to answer your question, I'd rather stay away from that market.
The focus in our portfolios are definitely the long side, equity side, and we just want to have stability. Of course, I agree with Mr. Heusen what the ETF side about the state bonds are, but of course in our strategies is an active fund manager, and for the corporate side, and then we are picking. It depends on the customer size. Yeah, in the bigger size, you cannot only use mutual funds, active or passive. You have to be individual. So we use single corporates. We also use currencies. It's difficult to say if there's a risk in the currencies. I think if we stick to the hard currencies, the risk is a bit predictable. So there is no high yield or emerging markets in our portfolios.
I think we talked about a lot about timing. So I think timing is very important, especially on the equity side, as you were all saying, is to find the right entry point and potentially trade, you know, the pharma company that's going to come out with that new drug that's going to resolve that virus problem. On the fixed income side, we're thinking that we are entering a golden era for credit.